Welcome back, folks. This is the weekend edition for the ICT Mentorship for January 31st, 2021. So this is the last commentary for January. And just real quick, I have to put this in here now because your attention span is at the highest it's going to be during the entire video. So I like to put the housekeeping things right here. So that way you know you're listening to it right away. You can't forget about it. And if you have a notepad, you can write it down on your notepad as well. The new members that just started, you paid essentially for the full month of February 2021. So technically, if you're only going to be here for 1 month, and why you would only be here for 1 month is beyond me, but it happens. You will be able to stay until March 9th. On March 10th, if you haven't made your second payment, then you will be removed from the mentorship. Now, it doesn't mean you're kicked out permanently. It just means that you have until April 1st to make your second month's payment. If you don't, then you're absolutely canceled and there's no way for you to come back. I am asking those individuals for your assistance like I did when you came in. The date that you signed your enrollment agreement, that was the date you should have made your payment. Some of you didn't do that, but most of you did, and it helped us not get bottlenecked with payments. If all of you just simply wait around to the last minute to make your payment for month 2, we are going to get slammed, and it's going to cause delays in you getting the content, and I don't want to hear complaints. You don't want to be complaining. So if it's possible, I'm not saying you must, okay? If it's possible and you have the means to do so, only thing I'm trying to avoid is frustration on my staff's part, my part, and you as the student. If everybody waits to the last minute and you just send it whenever you want to, we're not going to be able to take care of you in a very quick and expedient way. And that's all I'm saying. For those of you that already jumped the gun, there's a lot of you already that's done this, that's already made your month 2 payment. You will not have your access given to you for month 2 until the 27th of February. The 27th is when we roll to the next month for people that paid early. Okay, so that's the beginning of our next pay period after this one closes. And whatever date you paid, just change the month 1 month forward and make that payment the same time the next month. And if you just do that, you will be helping us tremendously. And I promise everything will be fine. But some of you can't do that, and you have to wait for your paychecks or whatever, or your bills to balance. I understand. But just know that if we have this issue where everybody's waiting the last minute, there's simply no way we're going to be able to do it. Many of you that came in, I'm not going to be able to have that many people to do it. So it worked out beautifully thus far. If you could help us by doing it this way again and throughout the mentorship, it's just going to be a much more pleasant experience, both ends. You as the consumer, me as the merchant, everybody will be happy. All right, and this also will not really be a teaching lesson because technically we are beginning our new month on Monday in February. So all of your content for month 1 technically begins this week. So if you haven't already got yourself some notepads, you should be getting them and having it ready for this week's lessons. So let's get on with this one. It's basically a general commentary, dollar index, euro, and cable. All right, so the economic calendar for the month start on Monday for February 1st. Medium impact final manufacturing PMI for cable and 9:30 a.m. Canadian dollar medium impact manufacturing PMI. 10 a.m. high impact ISM manufacturing PMI, and 10:30 p.m. for Australian dollar high impact rate statement and cash rate medium impact. On Tuesday at 4:45 p.m. for New Zealand dollar high impact employment change and unemployment rate. 8:30 p.m. Australian dollar medium impact speaker. Wednesday 4:30 a.m. cable medium impact final service PMI. 8:15 a.m., medium impact for the US dollar, non-farm employment change, and 10 a.m. ISM services PMI. Thursday, this is the big one for the week, 7 a.m., which is New York session beginning. High impact for GBP or cable, asset purchase facility, Bank of England monetary policy report, asset purchase facility votes, official bank rate votes, monetary policy summary, and official bank rate. So lots of volatility Thursday morning. 8:30 a.m. on Thursday, medium impact unemployment claims. You'll see some flurry of activity around the 8:30 hour as well. 5:30 p.m. high impact Australian dollar speaker and medium impact monetary policy statement at 7:30 p.m. on Thursday for Australian. And finally on Friday, 8:30 a.m. Canadian dollar high impact employment change, unemployment rate, and high impact GBP speaker, high impact dollar hourly earnings, non-farm payroll, and unemployment rate. And that's our typical non-farm payroll Friday. And then 10 a.m. Canadian dollar medium impact for IBPMI. All right, so for those that are new here, and maybe you have not heard me discuss this in YouTube videos or in passing, this week, because we have non-farm payroll Friday, the way this works, and especially with the economic calendar for Thursday, really loads it up for standing on the sidelines. And I know some of you are probably hearing me say, we're waiting way too much, and it probably doesn't fit with what you were expecting. But you want to learn how to know when to hold your cards close to the vest, not trying to just go in and betting on everything. Non-farm payroll weeks, where we have what we see here on Friday's calendar, it has the US dollar non-farm employment change. That is a circus ride. It's hard to predict. I can do it sometimes, but most of the time I'm wrong. Okay, so if it was something I was more consistent with, I would trade that day, but I don't. And I teach my students not to do that as well. The way we use the economic calendar for this particular week, and it's typically the week that has the first Friday in it, and it'll be non-farm payroll. The Monday, Tuesday, and Wednesday of that week, we look for signals to test, trade, or practice in. We do not open new positions on Wednesday at New York Open. We can have positions open beyond that and manage them after taking partials into Thursday, but we're generally trying not to assume new positions after Wednesday, 7 a.m. Okay, so that's our typical procedure. That's the general rule of thumb when we have non-farm payroll market conditions. The purest price action is going to be seen on the beginning of the week, so Monday, Tuesday, and up to Wednesday's New York Open. All right, so here's the US dollar. This is our monthly chart. And if you're not ready, pause the video. I'm going to be going through this a little bit quicker than you've been seeing me do it. All right, so we have the close of January's trading, and we left a little bit of a fair value gap in here. So I'm leaving the opportunity for it to trade up into that, create a institutional order flow entry drill for the monthly chart. In other words, it may not completely come up here and close this entire little area in and touch this candle's low. I got a question sent to me, and it was regarding fair value gaps, and the question was along the lines, why is the low of a fair value gap always a down close candle? It's not always a down close candle. Sometimes it can be an up close candle. What you're looking for is these little periods in price action where one candle has a range that is defined with the previous candle's low and the next candle's high, where it didn't trade up to this candle's body or wick or tail. In other words, one candle all by itself, it just has this little area right here. That is a fair value gap. It does not matter if the candle after it is up close or down close. That is not. has nothing to do with it. Okay, that has zero effect on the nature of what we're trying to highlight. Okay, so what I'm showing you is an imbalance of, in this case, it's sell side delivery, and it has a lack of buy side. So this candle here, the last one here, that could be a down close candle too. But the fact that we have a up close candle, it's tried to make an attempt to go higher. If we take out this candle from January's trading's low, then it should have really no problem whatsoever getting below this low and maybe even into this volume imbalance, which you've been already primed to see in recent commentaries in the month of January. So I don't know what Sunday's opening is going to be. And when we get into the lower time frame charts, I'll give you my expectations and how I would work with either scenario. Moving on into the weekly chart. If you're not ready, pause the video. All right, so that same fair value gap here now has been refined with this one single candle. The same thing here. We have a down close candle. It's not up close. On the monthly chart, it was an up close candle we were looking at. So we're only looking at this one little period of just an isolated price delivery of one side in this. In this case, it's down. So do we need to get up in here? I have grown more reluctant to think that we're going to go up here. It might just be we're heavy and it should just roll right on over. I'm looking for that scenario going into this week, but because we have non-farm payroll, I could be wrong. I just want to remind you that this week, if I'm not right Monday, Tuesday, and Wednesday, then I'm definitely absolutely going to be wrong on Thursday and Friday with my expectations, because I have no faith in the delivery of price on those days. And the reason why, especially if you're new, because you're thinking, wait a minute, I thought IPTA is controlling everything. On the day before non-farm payroll and the day of non-farm payroll, there is generally the likelihood of manual override. And that means human intervention will generally creep in. And what you would normally expect to see in price delivery will be met with some kind of erratic price action. Something will come out of nowhere and create a stop run that you didn't necessarily expect. Okay. Now, in recent months and years, non-farm payroll Fridays have been far less volatile. They used to be really explosive, going all over the place. And it's not the case anymore. And I guess it's because most of the world is having issues with, employment because of all the COVID stuff. So, but prior to COVID, it was rather nothing really terribly exciting about the event, where it used to be really big and used to be very volatile. It's not so much anymore. So we're looking for a continuation lower, preferably on dollar, and higher prices on foreign currency. All right, so here's the daily. If you're not ready, pause the video. All right, so the premium level, I was wanting to see that again, trade to last week, and we stayed in a range. Okay, just tight little consolidation. You can't really do anything when it's like this except for scalp. That means working off a 1, a 5, maybe in a 15-minute chart at the most in terms of time frames. Anything else, you're just going to get frustrated. And this is the reason why I do a lot of my teachings with intraday charts, because you can still operate in this, but the majority of you that are more inclined to be a swing trader or position trader, you're going to struggle with this initially, but over time you'll see the benefits of learning intraday, because if you just take the identification of what the time frame is off or out of the discussion and just study the price delivery, you're going to see it's the same thing that you see on a 1-minute chart that occurs on a 2-minute chart, a 3-minute, a 5-minute, an 8-minute, whatever time frame you want to refer to. The same things are occurring on all time frames. That's the beauty of understanding how I teach price. You're reading institutional order flow. And the wonderful thing is, if you're looking for a model or a trade plan that specializes in trading setups that make 100 pips. Okay, if that's like your niche, that's your go-to, that's your model, that's what you're trying to work and strive for, then you can trade with 1 hour and 4 hour setups, and you don't even need to worry about holding on to really long-term positions. Those time frames will allow you to excel in those types of setups. If you want to catch like 10, 15 pip trades, you can do 5-minute and 1-minute charts multiple times a day if you know what you're doing, and if it's really a nice environment to be trading in. Right now it's not. It's just really, really tricky. It's not impossible. I'm not saying that I can't get in here and do it, or you can't do it. It just means that as a new trader, someone that's just came into the fold here, you would probably struggle or fail trying to do the things that you learn later on in this mentorship in this environment, only because you're impatient, you don't have the experience to guide you, and you're probably going to be influenced by the losses and the revenge, falling victim to revenge trading if you take a loss. So if we look at this daily chart here, I'm going to give you some ideas before we drop down into hourly chart. We've been consolidating. Nothing terribly exciting has happened. Throughout December, we had this rundown, and then January, we've consolidated. If we open higher, if we have a gap opening higher on Sunday, I'd like to see it trade down, fill in the gap, and try to make an attempt to rally. I personally would rather see it gap opening lower, trade up to fill the gap or make an attempt to do so, and then start to move lower. And then we would start looking for these ideas down in here as potential targets. What it does on Sunday, as I mentioned before, and I've said it throughout the mentorship in various places as well, but on my community tab on my YouTube channel, I mentioned two things I don't know. I don't know what the exact closing price is on Friday. I don't need to know it, and you don't need to know it either. I never know where Sunday's opening price is going to be. No one will ever know that. That's an uncertainty that will never, ever, ever. It's a mystery that will never be solved. And that's why you just simply have to wait and see and submit to whatever the price is going to do. The importance of Sunday's opening is, do we have a lot of excitement from Friday's close? So wherever Friday's close is and where we open up on Sunday, it kind of like sets the tone for the level of volatility. And because we have non-farm payroll week, there's typically a rush to find an opportunity early in the week, so that way everyone can square their positions on Wednesday and not worry about it on Thursday and not worry about it on Friday. So it allows for a longer weekend and a shorter work week. It also forces discipline, because if you cannot reasonably outline a setup on a Monday, Tuesday, then you have to say, I'll pass. I'll not do anything else the rest of the week. And it's hard for a new student to think that way, because they think, I have time, let me sit down and trade. Don't do that. You want to look at every single non-farm payroll week we encounter together as a mentor-student relationship. I want you to look at it the same way I'm teaching you here. And if you do this, I promise you, the things that you're afraid you're going to miss, you're going to look back and say, it's not even worth it. And you'll be able to focus your attention on more pure price swings that occur the week after non-farm payroll, in the midweek month of the month, and then going into the closing week of the month. All right, so here's the hourly chart for dollar index. If you're not ready, pause the video. All right, so we have a buy side liquidity pool resting up here, and the last up close candle prior to this run lower and fair value gap is your order block here. So it's a bearish order block, and this level here is the monthly fair value gap, the low end. Okay, so this is that low of the monthly fair value gap. So we have not traded up to it yet, and it may not trade up to it for a while, especially if we see weakness on Sunday's opening. But I'll get to this level in a moment. We traded down into this level here, created some relative equal lows. There's sell side liquidity or sell stops built up below here. We didn't go lower here, we didn't go lower here, and then we had this run up. This little area right here, I have a little light bulb in here. It's just a mental note for me to remind myself to say this fair value gap, if we trade below it, in other words, let's say we trade lower, okay, and we go below this, and if it trades back up to it, I would look at that low end of the fair value gap, which is this candle's high. If we traded below it and came back up into it, I would look at that as like a resistance level, and that would set up a potential trade for me that would make a run. If it hadn't already ran below these lows, that's what I would anticipate seeing as a short for me. If we look at the rejection block here, we have a up close. It's the last up close, or highest up close rather, in a swing high, and it runs through it here, and we sell off. We have a high, a higher high, lower high, and then it runs. So this was a stop run on this short-term high. It didn't need to run above this. So we have a high, a higher high, and then it breaks lower. The rejection block that you would use on this area or fractal is this one here. And you extend that through time. And this is something I just recently taught, and you can see the sensitivity there. I already got a lot of feedback off of that one. They're like, wow, this is really cool. Trust me, you're going to get a lot of these cool things and signatures in 2021. The price runs after rebalancing all of this and trading up into the last up close candle. So we have a rejection block and bearish order block. I didn't have enough space to fit it all in here. I didn't want to make it too congested with annotations. I want to leave room for you in case if you're printing these out or screen capturing them, you can fill in your areas where it's open places on your chart. You can put your own annotations in there. We trade lower, create a small little imbalance. This is a fair value gap. By category, it's a fair value gap. What type of fair value gap? It's a SIBI, sell side imbalance, buy side inefficiency. So it ran quickly on the downside, and it didn't offer any upside or opportunity for that paint roller analogy I use all the time to see if you can get paint applied on the upside between this candle's low and this candle's high. CE refers to consequent encroachment. That's the midpoint of a gap. It touches there, and we're sitting right here. We did run below the sell side liquidity here. We tagged that, came back up to consequent encroachment. Now again, back to the idea of Sunday's opening. If we gap higher opening and come back down in, I would look at that as bullish and look for it to run up into these levels here, run this area of buy side liquidity, and tap into this one. If we open lower on Sunday and gap up and fill it, if we run below here, I want to see it really make no attempt to bounce in here. I want to see it slice through that fair value gap and then come back up, treat this candle's high or midpoint of this fair value gap, which would be consequent encroachment, the midpoint between this low and this high. I would look for that as a potential sell at basically around 90-30, 90-28-ish. If it could create something like that, I would look for that as a low resistance liquidity run to get below here. Okay. That's pretty much what I'm expecting. I would rather see that scenario versus the opening higher and then trading down. But if it does that, then I'm going to elect to work towards that monthly fair value gap low. We have the order block in here. So we hit it once, went down into it again. So we have mean threshold with stops taken. So it could go either way. I'm just telling you what side of the marketplace I would rather play, and that would be the opening lower on Sunday, fill the gap, and then trade through this fair value gap. So if you listen to what I just said, I gave you an algorithm again, what I'm looking for with the filters, and it must do certain things. It needs to trade through this fair value gap like hot knife through butter. And if it comes back up to this level here, not to this low, not to this low, just to this candle's high. If it trades to that, that would be enough for me to potentially see a short if it's the right time of day too, like a kill zone or whatever. Then I would look for it to run below these lows. Okay. All right, so the $1 15-minute time frame. If you're not ready, pause your video. All right, so here's those order blocks and that fair value gap I mentioned. I'm going to see it trade through that if it's weak. And then we have another order block right in here, and it rallies up, hits the fair value gap, runs up, creates a gap, rallies through, comes back in, fair value gap, fills it, trades lower, one more time runs into the order block, hits the rejection block once more, and we've outlined that on the hourly chart. Then it creates a fair value gap and SIBI, sell side imbalance, buy side inefficiency. Institutional order flow entry drill, trades lower, offset distribution below here, rallies up, order block here. I've left some things for you to put in your own chart. Another gap, rallies back up into bearish order block and the mean threshold of that bearish order block. And it is also a rejection block, which we mentioned on the hourly chart. Trades up into here multiple times. Displacement, fair value gap, which it trades up to consequent encroachment here before closing on the week. So we had sell stops taken here and multiple attempts to go higher. So if we get an opening lower, that to me is going to indicate initial weakness. And I just outlined everything on the hourly chart that I'd like to see. But if it opens higher, all of the ideas about using this as a selling area change to, I would just wait to see what happens on Monday's trading. And then I'll have to refer to this if that does in fact occur. In other words, so what I'm saying is if we gap up, fill the gap and start to rally, this isn't going to be that much of an interest for me, at least for Monday and maybe into Tuesday, but we'll have to see what we do on Monday. All right, on euro dollar, this is our monthly chart. If you're not ready, pause your video. All right, so we have this candle's high and this candle's low. This candle only passed between the previous candle's high and the previous candle's low. That is what makes a fair value gap. All right, so we have buy side liquidity here. And we already mentioned the institutional order flow in previous discussions. So what am I anticipating here? I don't trust this pair. I feel like they want to keep sending it higher. So therefore, I am coupling that with the likelihood that we see a weaker dollar. Okay, we may not see the weaker dollar materialize until non-farm payroll. Okay, so again, it's one of those things you have to endure, wait for opportunities post non-farm payroll, but you can take some scalps and such ahead of non-farm payroll Friday. I'm thinking that we could potentially see cable trade up into the rejection block and the buy side liquidity pool that rests above this high. I'm going to go with this until proven otherwise. Now, what proves that no longer possible to me? If we trade through the fair value gap and lower. In other words, if we go below this candle's high on a closing basis. If we see that, hey, we're probably not going to go up here, at least no time soon. But I'm favoring the bullish side of cable still. All right, on the weekly chart, if you're not ready, pause your video. All right, so we have the fair value gap high, and this candle's low. There's your fair value gap. This one in here is the daily. So I have that in here for context. Just know that we have the wider fair value gap here as well, but we traded into that 2 weeks ago, and we came off of it, traded a little bit higher, but didn't create such a energetic run higher beyond what we've already seen here in the previous week. So I still think that this might also go higher in sympathy with cable. And these candles, even though they're weekly candles, they're really kind of small. So we're expecting some range expansion. Depending on what direction we're looking for, I'm telling you I would rather see higher prices. I would rather see it go higher. A lot of people are trying to call the top on euro. A lot of people are trying to call the top on cable. And the dollar being in consolidation has not made it easy to decide which way or the other. So it's been a scalper's market. I'm co-signing with the idea that I would like to see it trade higher and punish those individuals that are trying to sell short and then send the dollar lower. All right, on the euro dollar daily chart, if you're not ready, pause your video. All right, so here's the two areas that I have in mind. I wanted to strip it down to just two specific things I'm focusing on. There's other things in this chart, and you can look at the previous commentaries because they're still there and they're still salient, but the things that are shown here are the most important things to me. If we open higher and trade down, fill the gap, I would think that that would be bullish and would take us up into the fair value gap during Monday's trading, maybe into Tuesday. If we open lower, trade back up, fill the gap, then I would look for it to trade down into this area here this week. Now, because of the volatility that could be seen this week, I don't really expect this much volatility, but both of these fair value gaps could potentially be traded to inside this week. So one or the other could be traded to. But because I don't, and no one can forecast with accuracy where the opening price is going to be on Sunday, you have to have scenarios. And it's not plan A, plan B, and whatever one works, I'm right. I'm telling you, I don't know which one's going to happen, but I'm telling you which one I would prefer. So in respect to what I mentioned in the dollar index, remember I said I would rather see it open lower, gap lower on Sunday's opening, trade up and fill in the gap, and then trade lower after that. And if you're new and you don't understand what that means, if it happens, I will do a video and show you the presentation of what I'm referring to, and vice versa. But either way, we'll cover it. If we open up relatively unchanged, that sets the stage for a really quiet Monday's trading, and that means there will more likely be everyone sitting on their hands waiting for Thursday's GBP news. Okay, so that's one of the things I use for Sunday's opening. If there's big news later in the week and there's really no excitement on Sunday's opening, you're probably going to have a very boring Monday and Tuesday's trading. So that immediately goes to 1 minute, 5 minute scalping. All right, so we have the 60-minute chart for euro dollar. If you're not ready, pause your video. All right, so here is the levels I have in mind. Okay, the SIBI here, sell side imbalance, buy side inefficiency. We traded up into that on the 28th, came down, had some retracement, then pumped it up into the fair value gap in here. You'll see this clearer on the 15-minute time frame. So you may be looking at these saying, how are they anchored? I don't understand where that's at. These are actually anchored on a 15-minute time frame. But you can also see the high of this candle and the low of this candle. That would be your 60-minute sell side imbalance, buy side inefficiency. But this is actually more refined, and that's why I have it on my chart. It's calibrated on the 15-minute chart, not the 60-minute chart. So a imbalance that's within a larger, higher time frame imbalance. In other words, this could have a line and this could have a line, and they would be above this and this would be below this one. So instead of having two lines really close to one another, I'm bringing your attention to the more important one to me that makes more sense, which is the lower time frame, because the lower time frame is going to dial in that precision more and more as you go lower. The context is always framed on the higher time frame, but the precision is always based on the lower time frame. And which is funny, because when you hear other people talk about intraday charts, they'll refer to it as noise. And to me, it's sweet, sweet music. So we have buy side liquidity pool up here, and it has a lower high to the right. Okay, so we teach this as a low resistance liquidity run signature. In other words, it should have really no problem. If it wants to run, if it takes out this high, then it should have no problem getting above this high here, because we have the lower high. If we ever have a high to the right that's higher, that sets up a high resistance liquidity run. It doesn't mean it can't go above it. It just means it's more likely to take longer and have a lot more short-term pullbacks, which can be very frustrating. You can see the fair value gap. We trade up into that. Look at the bodies respecting the low end of that fair value gap. And again, you'll see the 15-minute time frame parameters that define this fair value gap. But look at the precision around the bulk of the volume being encapsulated by the bodies. Yes, you have wicks that go through it. That's always broker based. That means this is where they do their in-house work for stop running. Okay, and it's always going to be there. Don't get mad. Don't be complaining, because that's what you signed up for when you opened up your account. You just don't realize it because you never read everything. And 15-minute time frame for euro dollar. If you're not ready, pause your video. Okay, so here's that sell side imbalance, buy side inefficiency levels, and the fair value gap, but just transposed into the 15-minute time frame. But this here and here is on the 15-minute time frame. Now, I don't have the video showing, or the chart rather in this video, showing where these are anchored. On your chart using forex.com, you can find these levels here if you pull up a 15-minute time frame, and you'll clearly see the sell side imbalance, buy side inefficiency, and the fair value gap. And you can anchor it based on what you see back here on the 1 hour chart. You can find the fair value gap in this candle, and you can find the sell side imbalance, buy side inefficiency in this particular candle. But these levels are anchored on a 15-minute time frame. So I'm teaching you to go into your charts and find these very specific things. Now, some of you that are new will be thinking, well, this is mean. You should just give it to me. No, there's always some work that you have to do on your own. And this is part of your development. I'm not hiding it from you. I'm showing you where to find it based on what you see here. But look at the reactions in here. We have the price run below this short-term low here. So we have a stop run. Everything that was below this in the form of a sell stop was rated. Then we had a run, which created a fair value gap with an order block, last down close candle. This is a stop run here. So if we ever have a low with a lower low, a couple things form. We have a breaker, which is the last up close candle here, extending out in time. If we ever trade above it and come back down in, that's a bullish buy. And you see that here. It's not annotated. It's for you to annotate on your chart. But this low, high, and lower low, we use the previous low, the lowest close. That's your rejection block. Extend that out in time. Cut through candles. We're not Sam Seiden. We're not Online Trade Academy. We're not teaching supply and demand. If we trade back down into it, that can also act as support. So we sweep below it. We do not go below this low. We go into the order block here, and we close in the fair value gap between this candle's low and this candle's high. Which order block do you buy, Michael? Down close candle with a fair value gap with a context that's bullish. It trades down into it, into the rejection block, and then hits it one more time and sends it higher. Now, the astute trader will notice that this is a market maker buy model. Consolidation. Some of you that are new are like, whoa, do you have like the easy start course? Like, do you have the layman's course on all this ICT? I don't teach basics, okay? And basics can be acquired through like baby pips. And I don't mean that to be, ignorant or anything like that. But I promise if you just go through the lessons I'm showing you, I'm preventing you picking up all the bad stuff. Because all of the easy stuff that you think that go in there and learning the easy stuff, the elementary level lessons, you're going to pick up bad habits if you do that. Okay. And that's why I reluctantly say baby pips, because there's a lot of garbage on that website. Okay. That is taught as important, and it's not. Like, there's school stuff. All you need to know is what charts define from each time frame. What does a monthly chart really define? The highest high and the lowest low, where it opens, where it closes for that 1 month interval. And then the same thing for a weekly chart, a daily chart. And if you can have that much understanding and you come here and you have no indicators, you have no retail logic, I have a fertile mind to really plant success. Usually the problem is I have people coming to me and they have the guppy system. They have supply and demand. They have Elliott wave. They have harmonics. They have whatever. Okay. And it's such a hard thing to navigate through that mess that they don't want to let go of, because you think you've put all that time into it. It would be a waste for you to just throw it to the side when it's in fact the best thing for you to do. Just get rid of all of it. And it's hard. It's hard to let go of that luggage, because I had it too. I had years of it. And I spent a lot of money on books. So it doesn't feel right to say, I'm going to abandon this investment I made on myself, because I just know if I spend a little bit longer, because here's what you're thinking. You've probably seen that little cartoon where there's two guys digging and they have a pickaxe, and one guy stops and turns around, quits. And he was like inches before he hit diamonds on the other side of the dirt. And the other guy, he dug in and got to the diamonds. And you're thinking that's going to be you if you stop where you're at. Well, just let me save you a lot of time and frustration and money. Stop with all the retail stuff. Just don't do it. Don't even do it. Don't even look at it with morbid curiosity, because the things I'm going to teach you about it is going to be the only importance around retail logic, so that way you can use it against them. But we have back in here the bulk of the volume was inside the SIBI. We trade up one more time, and then it breaks lower. We have a bearish order block. And right here, this down close candle is a mitigation block. Why is it a mitigation block? Because you have a high, a low, a lower high. So the down close candle in the middle, that's not a breaker. It's a mitigation block. So I have a dotted line in here, or dash line, and I'm showing you that in the mitigation block. And inside that mitigation block, we have a bearish order block right there, and it trades up into that. That's a sell. And you could use the fair value gap here. You could have went in short there. You would have had to absorb some of the drawdown, but you would have to have your stop above the mitigation block, and preferably above the order block. So that might be a trade that's a little too rich for some if this was a larger time frame, but it's a 15-minute time frame. We're not even talking about that much in terms of pips, but that could get you in sync with going short. Then you have an institutional order flow entry drill here, where it trades up into this fair value gap. Now we have a down close that creates the fair value gap, because the next candle is what? Down. So the individual that sent me the email saying, why does the candle need to be this? Don't think about any fair value gap relying on the up close before or after. That has no bearing on it whatsoever. You're just looking for the imbalance that's created by one candle, and it goes up into consequent encroachment, which is the midpoint of a fair value gap, and with an institutional order flow entry drill. And some of you have sent me emails saying that that is one of the coolest little entry patterns that they've ever seen, and they found it in the forum. You just click on the search tab and type in institutional order flow entry drill, and it'll take you right to the commentaries that have me teaching about it. And it's a little bit more than what I'm showing you here, so that way it helps you. And you can also go into your charts and practice and see how often this pattern forms. It's every day there's one, always, every single day. And that's why I said, if you learn what you're being taught here and you just take your time and don't worry about the money, don't worry about the time it takes for you to learn it, you will be able to replace your job. Okay, that's the number one thing you came here for, is to learn how to make profitable decisions. You cannot do that quickly, but you have to study a lot. And the way you look for these little patterns is you have to know where it's drawing to. And it's either going to be a liquidity pool it's drawing to, or an imbalance. We had all of this imbalance here, buy side imbalance, sell side inefficiency. So all of this has been a run on the buy side. It rebalances down here. It runs back up into a fair value gap, consequent encroachment, and then sells off. Trades up into an order block, these last two up close candles, trades up to it, and then sells off. And then hits the fair value gap, bullish order block, rejection block. How many PD arrays is that? 3. Market takes off, smart money reversal, low risk buy. This is all based on market maker buy models. Okay, you'll learn about this. And I had another question, how should I be taking notes? Because there's a whole lot of stuff. I want to make sure I'm doing it the right way. Well, you're in month 1. So everything in your study journal that I gave you as a spreadsheet, you put all your questions and your ideas that you're learning in month 1 content in that month 1 area. And as you go through, you're going to start seeing questions pop up that have to do with entry patterns or the pattern recognition ideas, or what sets the stage for a trade to be bullish or bearish, and these things, because you're learning new lessons in the future, it would be foolish for me to kind of like draw on things that would just be more enticement for you to have more questions come up when you already have a lot of them coming up now. And what will end up happening is you'll have 100 different questions, and you'll have this impulse to feel like you've been wasting your time. You didn't learn anything. You just created more questions, and that's normal. But I force you to have a perspective on just a few things. But in the commentaries, I'm teaching all the students from charter level to brand new like you all that just started on month 1. So I'm trying to keep things salient and moving along, but using the right now market. And I'm putting everything that you're eventually going to have exposure to and lessons into the marketplace and into the chart. So that way you're learning by pseudo experience. I'm lending you my experience, and then we watch what price does after the fact. Okay, so I'm outlining what's salient so that way you can identify it, learn to see it because of repetitive, visually seeing it in the chart, and also my commentary. So you're seeing something and you're also hearing things around it. And over time, this exposure trains your eye to anticipate it in the charts when you're watching it yourself live. In my experience, being able to read all this stuff going forward is what you're trying to benefit from. And once you get to the chart, remember, you have everything. You'll have everything at your disposal where you can just put it all together. So we have the smart money reversal, low risk buy, reaccumulation, order block, trades down, hits the order block, runs through the down close candles. You want to see that. That's institutional order flow signatures. That's telling you that it's bullish. If down close candles are being traded through, they should act as bullish order blocks later. It trades the open here, which is above this candle's high. It opens, trades down, hits the order block, rallies away. We have another down close candle. When it runs through it, this should act as a bullish order block. Price trades down to it here, hits it, runs away. Trades down to it one more time, hits it, runs away. Why? We have a fair value gap right there. Down close candle, the high. Remember, the down close has the order block only. Then this one single candle here runs higher, and the next candle's low there. So your framework for the fair value gap is defined by this candle's low, this candle's high. This is the little area that needs to see efficient delivery on the down delivery. Okay, in other words, when price is up here, it's efficient to see it trade down and touch this candle's high. Why? Because the paint was only applied to the canvas of the chart on the upstroke. And as it does this, there's going to be small little pockets where there hasn't been prices offered efficiently to traders that can sell it. So the market trades lower. And this is why the algorithm does what it does. It efficiently offers selling opportunity in this area between this candle's high and this candle's low because it passed too quickly on the upside. So sellers didn't get a chance to sell in this buy run. So the algorithm makes concession for them by offering a drop down into it. And that's the reason why the mechanism does what it does. That's the reason why the markets do these things. It has absolutely nothing to do with what you learn in a retail trading book or course or educator. None of that stuff has any bearing on why the price action moves occur, period. Okay? You're going to see this idea and all the things I'm talking about over and over and over again. My question to you is this. Find this in Wyckoff because it doesn't exist. It does not exist. If this stuff was anything other than what I just said it was and what I've been saying for years, it's algorithmically driven. None of this stuff is random. If it was random, then it wouldn't happen so frequently and so precise. But because it does, why is there an argument? There's still people in my mentorship that come in with the expectation they're going to prove by learning a little bit more from me that there really isn't an algorithm, and I'm going to tell you the secret. No, it's algorithm. It's all it is. Okay? I know how to read it. I know what it's trying to do. There's sometimes I don't know what it's doing, and I'm smart enough to say, I'm going to hurt myself if I try to do something right now. And I'm hoping that you learn from that from me. Because if you don't, you're going to learn the hard way, and it might be a lesson that you can't come back from. And that's what I'm trying to hopefully help you avoid. So we have the fair value gap. It runs up, hits the fair value gap that was outlined on the hourly chart. Remember, there was two fair value gaps. The sell side imbalance and this fair value gap here. It trades up into it here. The bodies shoot over a little bit. It's not a big deal. Trades back down into the order block and fair value gap. One more pass into the fair value gap. So this is a volatility run here. You can look at this on a 1 minute chart. And that's pretty interesting also. You can see a nice little study in that for people that are more versed in my stuff. Obviously, as a month one student, you're probably gonna look at that 1 minute chart and really not see much at all. But for charter members, that's like a playground in here. And we consolidated going into the close on Friday. Relative equal highs was the target on this run from the rejection block, order block, and fair value gap combo. And it also clears the market maker buy model. All right, Eurodollar on the 5 minute chart. This is what you're supposed to be doing every single day. You should be dressing your charts up and studying what you think you see and then testing it with the ideas and things I show in my chart. So if you're not ready, pause your video. All right, so we have the London Open kill zone. The market trades down. I know some of you are pondering, why don't you have the Asian range on your charts, Michael? Why don't you have central bank dealers range on your chart, Michael? Because I already have a lot going on, and I'm probably destroying the new students that aren't very versed in my stuff, and this probably feels like it's way too advanced. Keep listening, keep taking notes, and you're going to hear these things repeat. I'm not throwing 50,000 new things at you. I'm teaching the things that you're going to learn in the core content lessons each month. But because I'm conditioning you to see them, I'm literally taking your attention to them in the chart. Whereas otherwise, just by you watching the lessons, you're still not going to have the ability to go into the charts and find most of that. So this is the reason why mentorship is these commentaries. With me pointing them out, showing you where it's relevant in the chart and how to use it going forward, that is the thing that is mentorship. It's not those static lessons. Those static lessons are useless in the hands of people that are not being mentored. They're just like anything else that I could demonstrate. It's like magic tricks. Okay, I could show you all kinds of really cool card manipulations. I know them. I can do them. And just showing you the trick is like, whatever. But taking you behind the illusion and the sleight of hand and teaching you how it's done, then it's much more meaningful to you, because then it's something you can replicate in your own hands. Just saying, oh yeah, I know how that trick works. That's pretty much what most people do. They think, I'm not a real big card trick fan. I know how that trick's done. But can you perform it? No, I don't care. I just know how it works. To me, that's boring. I'm not impressed by someone that says, I know how that's done. In trading, just because you think you know how it's done doesn't put money in your bank account. You want to understand how to do it. But there is no shortcut to getting to know how these things are done unless you spend time over the shoulder of somebody that knows how to do it. And I'm giving you the best way of doing it without physically giving you trades, because you will not learn anything except for dependency on me giving you trades. That's not what this is. And that's why you signed the agreement knowing that it's not trade signals. I'm teaching you how to find it by exposure over and over and over again. So with all that said, London Open kill zone, we will see charts with Asian range and central bank dealers range. I'll do all those things. But in the beginning, you need to see these patterns, these things that I'm showing you right here, because this is the majority of what it takes for you to understand all that other stuff being the standard deviations and the precision elements that go along with intraday trading. That's what you want right now. You want the precision entry, the precision exits. Make me money. That's what you want. Okay. But I'm telling you how to get to that level. And you need to see these things happening. What is it you're supposed to be seeing by doing this, by the way? By having your charts annotated with the kill zones, it teaches you there's specific turning points intraday that take place. And then there's price runs that occur from those kill zones. A kill zone is a specific time of day, like 2 a.m. to 5 a.m. New York time, 7 a.m. to New York time, 10 a.m. to noon New York time. So you can see there's a turning point here. It runs. It creates an optimal trade entry here. Comes back a little bit deeper, but this to New York is still an optimal trade entry as well. And price runs through into the SIBI. And it hits this high prior to 2 o'clock in the afternoon. It creates the high here during the London close. So what am I showing you here? Everything that you learn in core content, in those specific lessons, I'm showing you how it unfolds in the chart. Low of the day in London, high of the day in London close. continuation pattern in New York. This is a model. If you anticipate this and finding this once a week, you never need to do anything else. I'll teach you lots of other things, but if you can see this pattern here as your model, you don't learn anything else except for just making this one better. You will be financially independent. If you can control yourself and control your money management and not overtrade, this pattern right here is it. That's all you need. And you only need to find one of them a week. Now, what does that look like? Well, you can wait for London to form and sleep all through the night and wake up around 6:30 in the morning, New York time, and be in front of your charts until around 9 o'clock in the morning. Your setup's going to form prior to 9 o'clock. If you don't have your setup by 9 o'clock and you miss it, then you look for institutional order flow entry drill, because you probably missed the initial run and you have to catch something in here on, maybe a 1 minute chart or something like that. If you see the pattern here over time, now again, you're going to learn lots of patterns and ideas how the algorithm operates. But this is one that's just really easy. It's generic. And this is actually what's taught on my YouTube channel. But just seeing a video or a series that talks about something and not pulling it out in price action week after week after week and explaining things on top of it, and also building in the narrative that I share with the audience here with what I think the market's going to do, it helps you trust what you're studying because you're tapping into my experience. And by looking at the charts with that perspective, it just feels much more confident and it makes it more interesting. And then when you start seeing price runs like this, it's hard not to smile and think, man, where am I going to be at 2 years from now? Where am I going to be at 5 years from now? And that's what I meant today on my YouTube channel when I was typing my typical Saturday entry on Community tab, is that you as a student here have made it your decision to pursue success. And part of that is finding the thing that you do very well and easy. And that's going to be a discovery for each of you. I don't take you and press you into this is how you trade. This is the only way you need to trade, because you're going to see patterns in here that make a lot more sense to you because you've been exposed to modular concepts. And by default, you will gravitate to the things that make sense to you because your eye, your understanding about price, and your personality is going to gravitate towards a specific framework in what you see in price. And it's this crazy thing that everybody that comes to me struggles with. How can we all have something different if we're learning the same things? You'll understand it when you get your model. Your model will come to you because you'll see it. You'll see the pattern. You'll see the number of pips that you're looking for, because I don't say you should have what I should be expecting each week, 50 to 75 pips a week. Don't think that's what you should have. If it's more, then let it be more. If it's less, then let it be less, and be content with that. Who cares if you're looking for 25 pip moves and you never really get a 100 pip move? Who cares? Because you can take 4 25 pip moves and make that same 100 pips. You just got to do 4 transactions to get it. It's all relative. But this pattern here of finding the turning points intraday, low of the day in London, continuation in New York, high of the day in London close, that is classic buy day scenario. It's classic. Where do you find this? When the market's predisposed to go higher on the 4-hour and daily, within the context that the weekly chart could expand higher. Now I just gave you a mouthful, but all those things together combined, if you have those, this pattern here is easy to locate, very easy to locate. And the market creates a mitigation block because we have a high, a low, a lower high. So the down close candle in between, it's this to here. You extend it out in time, and then we bump up at the bottom end of that sell side imbalance, buy side inefficiency. Again, all the things I showed you on the hourly chart and the 15-minute chart, that's this level being transposed here. And I got also another email. How do you make your charts not look so messy? And that's an art form for you. Okay, you'll grow into your own annotations. I get a lot of compliments, and I'm not trying to pat myself on the back, but when I first started, my charts were they were a mess. Okay, and it was very hard for me because I have obsessive compulsive disorder. Everything, like for instance, this here is driving me nuts. This line should be sitting right on top of this candle in my mind, and this one here should be right here. But because it's been transposed from a higher time frame down to the 5-minute, it always extends beyond because it's inside of the same time frame candle. It's just not anchored to the very candle that makes the most sense on the time frame you're looking at when it's a lower time frame. So I had to learn how to be artistic in my charts. I am an artist. I draw and I've painted. So I kind of like treat my charts the same way. And when I do a chart, I look at it as this should go into a textbook. And if you're smart and you're thinking about what I just said, I'm giving you every single day of this coming year, well, at least since you started with me doing this, every single trading day, I'm outlining it and showing you in the proper context of what's salient based on the things you learned from me. So you're going to have a whole entire 2021 scrapbook of each day on Euro and cable and whatever market I may introduce also along the way. So this is what we got for the 28th of January for Euro. Let's go into the 29th. If you're not ready, pause your video. Real quick, this one here, obviously you can see it's going up, but just not what I would have remembered as a new trader seeing and thinking, oh yeah, I can see there's trades there. Because when I first started, this would have made no sense to me. But using the annotations now, London Open Kill Zone, market trades down to that rejection block. What rejection block? Earlier in the video, you heard me talk about it. It finds some support there, rallies up, trades back down into the order block here, rallies up, small little fair value gap there. Look at the bodies right into that, right there. Fills it in right there. Yes, we have a tail. Yes, we have another tail, but it's the bulk of the volume inside the bodies of the candle. That's what I'm focusing on. I'm not worried about the wicks because my stop loss is always outside of the realm of within its reach or a broker's spread. I'm not trying to trade with the myth of 2-pip stop losses because they don't exist. Okay, you see these guys on Instagram and Discord and whatever. Oh yeah, I'm trading with a 2-pip stop loss. Or the guys that are trying to teach my stuff over there in the Middle East and claiming they use 2-pip stop losses. And I have $150,000 says they can't do it, and they never came to get it. So the price runs from the order block up. One more time, trades lower. Small little rejection block there. Runs up. Order block, down close candle, fair value gap again, trades down into the order block with a fair value gap. Which order block do you buy, Michael? The down close candle with a fair value gap with the context that's bullish. What's it reaching for? That fair value gap. Is it reached that fair value gap from here? No. We have potential for this order block to be touched and trade up to the low end of the fair value gap. Not consequent encroachment, not the high end, just reach and touch that level there. So what's the framework that your eye should be training to find a repeating phenomenon in by seeing this example? Well, you have a fair value gap with an order block. It's running up. This is also not during the easiest time to trade. This is when the real setup forms in London. Here, we're between New York Open and London. But if you see this formation, there's nothing wrong with taking that as a trade, because this is a institutional order flow entry drill on this candle, or trading down to the fair value gap closure, or consequent encroachment, which is the midpoint of the gap. And again, I know this sounds like mumbo jumbo, but I promise you, the folks that have been here for a while, they're smiling listening to me say this because they know what I'm talking about, because they had to go through what you're going through right now. Months and weeks and days of all this stuff that doesn't seem like it makes any sense hearing it the first few times. And probably the whole month of February, you'll still probably feel a little bit confused about what I'm saying. But I'll keep putting you in front of the chart and pointing to things, and you're going to say, oh, I see that. And by repetition, showing you the blank chart and then putting my annotations over top of it, you're learning. Just like a hunter takes his son out to the woods and says, look at the ground, and you tell me what that is right there. And it's a deer track or it's a bear track. What makes it a deer track? What makes it a bear track? What makes it a dog print? The way it's shaped and how it leaves its markings. You have to have someone that can see it and show you how to find it in the wild. When this chart is empty like this, that's the wilderness. You know, find the footprints. Find the footprints of smart money. That's what I'm showing you here. It's relative to time and price. Now, back to this example right here. When we trade down into this fair value gap here, it creates another run, which creates another fair value gap here, and consecutive down close candles, which is a bullish order block as well. This small little imbalance needs to be rebalanced with what? A down move in between this candle's low and this candle's high. So we have a fair value gap in here. Order block is being identified here for the purposes of this annotation, which is fair value gap and bullish order block. So it's the order block that's being anchored, but the fair value gap would be this candle's high, this candle's low. Which order block do you buy, Michael? The order block that's down closed with a fair value gap with a context that's bullish. In here, buying this, you're at the beginning of the New York kill zone. Yes, this is a good one. Do you have range between where you're trying to buy and where you think it's going to go? Well, you think it's going to go up to this fair value gap. What's the easiest low-hanging fruit target? The low end of the fair value gap, this line. So buying here to here, it's about 20 pips or more. So you can buy here. As soon as it touches here, you limit out, you're done. What's wrong with that trade? Nothing. Until you have to ride this here. Because you're too quick as it starts to run up. You're in a hurry to take your stop loss and jam it up in to lock in something. You'll learn how to manage all that. But you have to take one step at a time. So you have an optimal trade entry from low to high to low. So there's an optimal trade entry for New York Open. And you also have a New York Open low to high down into optimal trade entry here. You can do this on your own fib during New York Open. Then the price runs up into the fair value gap low and beyond it, just by a little bit, and consolidates in it. And then in London close, we create a lower high, which again I mentioned, it's going to happen. It's just a target for time, but it creates a significant high there and doesn't go any higher the rest of the day. So we were a little bit early on the high forming of the day on Euro on the 29th. This is a 1 month chart. Okay, pause the video if you're not ready. All right, so we have a buy sell liquidity pool is high, rejection block. These are the objectives I'm looking for if I'm correct in my assumptions that the dollar index should go lower. This would allow cable to rally higher. And if it does, this is what I'm reaching for. Okay, so it's a pretty significant price run. I'm thinking that we traded down to this down close candle, which is a bullish order block. We also traded back into this old high, and we reacted, pretty nice off of that. So we have a small little range here. Anything bullish from here should see a large range form. So we could potentially see February have a large range. This here, I wanted to talk about this also earlier in a lower time frame chart, but I got talking and I forgot about it, so I'm going to teach it here because I knew I had another example of it. A fair value gap like this high and this low with this one single candle. So in other words, if you draw this line out over here and this here, between this two price points here, this is an imbalance of only buy side. You're going to anticipate at a later time price eventually coming back down into that because it needs to offer sell side. It offered buy side with the market going up. A fair value gap is a deferred rebalance, meaning that when it forms, it'll take time for it to eventually get rebalanced. There is something that I'm going to teach you now that's called an immediate rebalance, and that's seen by here. We have a candle's high, The next candle, we trade above the previous candle's high. And then the next candle, we open higher than the previous candle's high here. And then we trade back down into the previous candle's high. So there is no fair value gap here. It's an immediate rebalance to this candle. Whereas as I was outlining this candle's high in the relationship between this candle's high and this candle's low, the range is seen with just one up candle moving up between this candle's low and this candle's high. So your eye is being trained to look at just this little portion of price action and then eventually expecting it to trade down here at a deferred time in the future. If the market has a high and the next day we trade above that high and the next day we open above this candle's high, if it trades back down to this candle's high, this is an immediate rebalance. So this is something that I watch intraday. And if I watch, and this is why I also teach you to look at the last 3 days, that this is the secret why I teach it in my YouTube channel. I tell you to look at 3 days look back all the time. You think it's just the swing highs and swing lows because that's what I said there. But I also said that I left a lot of things out of YouTube. This is the reason why I tell you to look at the last 3 days for immediate rebalances. So the opening on this here, if we watch this on a hourly chart, because this is a monthly chart, it's the same thing. So if this hourly chart closes here, the next candle opens here, and we trade down to this candle's high here, that would be a buy right there for me. If I'm already bullish, I would be in there all day long at that, buying hard and anticipating a range expansion on the upside. This is also how I've taken the ideas that I learned from Larry Williams, where he taught that buyers that buy below the opening price and at the low of the day, he wished he knew their zip code. Maybe that would help him. It was a rather silly statement, but I made that my point to go into the charts, hunting that, what made that tick. And that to me, like I said, I have amazing entry patterns. You're going to be so fascinated when you get into those lessons because there's more of them, charter members. You think you learned it all, yet you haven't. We got some really good stuff this year, but nonetheless, this is what we look for in rebalancing. Okay, you won't see this taught in like Chris Laurie stuff. Okay, that's not in Chris Laurie's stuff. It's not there. And no other textbook, no other teacher talks about it. It's mine. I found it. It was given to me by Grace. Not Grace, a lady, but God. And he opened my eyes to seeing it. And once you see it, and you'll see many examples of it, it's fascinating. Because as long as you have the context correct, in other words, what you think you're seeing is bullish or bearish, I'm either waiting for a deferred rebalance with a fair value gap, or I'm buying an order block or selling an order block, or I'm trading off of an immediate rebalance into a liquidity pool above an old high or below an old low, or into an imbalance. Now, I could be, say I'm in this here, and I'm basically bearish, or I'm indifferent to the market. I just don't know what I want to do, but I see something at this opening price that looks bearish. I could sell short this market and aim for this candle's high. And that would be also trading with the immediate rebalance in mind and not holding on to the position too long. And that's also some of the things you see me do on my YouTube channel, trading with a 1 minute chart. And the spectators that watch that video have no idea what I'm doing. They might think they do. Oh, he's trading off this order block. No, it's not all that. It's something like this also. And a half a dozen things else that you haven't learned yet. So the likelihood of this moving higher, that's what I'm looking for. Okay. And I want to see it try to get up to here if we get this real big weakness on the dollar. All right. And the weekly chart for pound dollar. If you're not ready, pause the video. All right, so we had the buy side liquidity pool, as I mentioned before. We have a rejection block. Why this one and not this one? Because we have a higher high here. So this is a stop run, and you use the initial high because that's your real high, and this is a run for liquidity. So this is the one they priced in. This is the one they take the traders out of so they can't participate in the context that was formed on the initial high. So the up close in that swing high, extend that out in time. That's your rejection block. I think it's going to trade there if we continue higher and lower in the dollar. We have a breaker here, okay? I mentioned that I would show you the breaker level that was being shown in my previous discussions over the last 4 videos. I've talked about the breaker level on cable. It's this here. Now, why is this down close a breaker? Well, like I showed you in regards to a mitigation block, mitigation would have a high, a low, and a lower high. We don't have that here. We have the high, the low, and the higher high. So that makes the down close candle that's lowest in between those two highs a breaker. And we've been banging on that here a few times. Now, the fact that we have not shown any real sensitivity and hard sell-off from there leads me to believe that we're probably going to press up higher. And it might do so with a big candle. So I've been kind of like anticipating this thing, trying to do something more grandiose on the upside, more energetic to the upside, and just really upset the people that want to sell short. Even I did last week. I was giving you an idea that maybe it could trade below that potential fake trend line I was showing on the chart. I've already told you I don't want to touch this pair, but gun to my head, I think that this is possibly going to drive up into the order block here. These last two up close candles prior to this run lower. That's the order block, this low, extending out in time. That's what the negative OB stands for. Negative OB is a bearish order block. If it had a little plus symbol in front of it, it would be bullish order block, like it is here. Okay. And I think that's going to be all that's necessary on this time frame. Let's drop down to the daily. You can see it's pretty ugly. If you're not ready, pause your video. All right, so here's that bearish order block, and we're at that breaker. It's just hanging around in here. I would have rather it tried to go lower and knock out those stops I was showing you with that trend line idea, and it didn't come to fruition. It would have been better had it done that and then still be primed for this week and then look for something that would expand on the upside. I think that we're going to see large range soon, because look how tight these little ranges are. You know how we went from small ranges to big ranges, small ranges, big ranges, small ranges, big ranges, small ranges, big ranges. We've been in here with small ranges for a while, and it hasn't been trying to drop. So what mode of punishment would be best in a sense of trading against a fund level trader? What would they be wanting to do in here? Well, they want to see some kind of a sell-off. So if they're trying to sell short, how do you punish them? Keep driving it higher. So there's all kinds of issues going on with pound. It's the Brexit still. It's the lockdowns. It's its own form of enduring the COVID nonsense. So all the things that's being pressured on the UK, they're all factors, and Brexit is still there also. Which is also another reason why I've been reluctant to trade cable, because I don't understand Brexit. Okay, and I don't know why I get emails from people in the mentorship that will say this is something that they can't understand, why I wouldn't know more about. I don't know, and I don't understand how anybody could say they would expect reasonably how to see what price would do with Brexit factored in, because you don't know what the central banks are going to do. You have no idea what they're going to do. Just because Brexit really unfolds and it separates itself from the Eurozone entirely, okay, great. But what does that mean, and how does the central banks reprice currencies based on that? You don't know that. No one knows that. And that uncertainty creates a great deal of confusion, and you can see it in the price action. I mean, look at it. It's like a heart attack in here. Yes, it's going higher, and I've been calling it higher since back here. But the point is what risk are you incurring by trading? A lot. Because I think this is going to have a swan event in it. I just think it will, and I know as soon as I put live money in it, it's going to be that day. We've been waiting for you, Michael. Come on in. So I don't want to touch this one. Okay. So like I said, the longer it trades like this, the more likely I'm going to bring in a different currency in its place. And it might be, Australian dollar. It might be, dollar CAD. I don't know what it's going to be. But we'll have something else in its place should I need to remove it from rotation. Hourly chart on cable. If you're not ready, pause your video. All right, so you have your buy-side liquidity pool here. Mean threshold of the last up-close candle, bearish order block, which is being annotated here. It hits it here. Rejection block, this closing price. Not this one, because this one runs through this high. So extend it out in time. We trade through that rejection block and an old high here too. And runs lower. Back to the 28th, we have the market trading down to order block, rallies up, and we have a projection block. You'll learn about these in month 4. Okay, so we have an order block, another candle that's on top of this order block. We don't want to see it trade through 50% of the order block. That also confirms the projection block. And we have a buy side imbalance, sell side inefficiency here. And we have another one here to here. The market runs up, hits the order block, trades lower, trades back up into the bearish order block here, sells off, closes into buy side imbalance, sell side inefficiency. Mean threshold of the projection block. This candle's high, this candle's low, split that in half. Projection, mean threshold. Trades to it here and trades into the rejection block of this closing price. Why this one, Michael? Because this went lower than the previous one. And then we had this big price run. So this drop down was a run on stops below this low. So the lowest down close, that price is your rejection block. So we have convergence of mean threshold on the projection block, rejection block, order block, all in here. So price runs up one more time and trades up into the mean threshold of this bearish order block there. Sells off and closes in the buy side imbalance here. It works again the breaker level. And that breaker level I showed you on the daily chart. So you can see all of the work in that breaker. It hasn't collapsed yet. And this is way too many times for me to be seeing a trade back into a breaker and not go down significantly. It just feels like, okay, it goes up here, it starts to break down. Okay, start selling short. Boom, they knock them out. Okay, starts dropping down. Okay, now it's really time to start selling it. And they sell it, and then boom, they knock them out one more time. Okay, now it's starting to drop one more time. Now it's definitely time to go lower. And then they're really going to ram it higher. That's how I would do it if I was making the market for cable. It just looks like, they have all these reasons in here to see resistance. I just see a reason to go up here and run it another 200 points. And that's what I would do. All right, so 15-minute time frame on cable. If you're not ready, pause the video. All right, so we have the sell side liquidity pool, optimal trade entry in here. Runs up, creates a buy side imbalance here. That projection block, the levels have been transposed into the 15-minute time frame. Inside that BISI, the higher one, remember this is the lower one and this is the higher one. And go back a couple minutes and you'll see on the 60-minute chart where those two specific buy side imbalance, sell side inefficiencies are. Inside the uppermost one, you can see now we have a more refined imbalance with the fair value gap. This candle's high, this candle's low. We have that candle right there only moving up. Just one candle portion right here. Extending out in time, we have sensitivity at the consequent encroachment, rallies up to a bearish order block, breaks lower, hits the order block, last up close candle in here, and consequent encroachment, all the conversions with a buy side imbalance, sell side inefficiency, fair value gap. What am I saying here? We went up here with this candle to be efficiently balanced, to make it a perfect, efficient market. It needs to come down. Does it fully go down into it here? No, it leaves this portion not traded to. It rallies up and then it trades down here. Trades away from it. Now it becomes a balanced price range. because we went up, down halfway, down through all the way, came back up, moved away from it. Now it's going to be resistance. See the logic there? Versus, oh, this is the old low broken turn resistance. Well, I can show you 1,000 of them things in price action where it should have done that. It doesn't. But when you have the logic that I'm outlining here, that's narrative. That's what's missing from retail logic. If you add retail logic to any old chart, you're going to lose. If you take retail trading tools, support resistance, and apply it to a narrative, and you're right on your narrative, then it works perfectly. That's the textbook examples everybody sees in their books or in the courses or if these gurus are teaching. That's when it works. But you have to have an understanding, why should it go here and trade lower? Well, from a resistance support idea, it's going to be, okay, support broken, turn resistance. So where's it going to go? Well, it's going to go down to this low here because that's support. Well, why did it go right to here and turn around and go up there? Because it filled in all of this rebalance that's necessary on the buy side. It went down and offered price going down. So it's the same paint roller analogy. Apply the paint to the canvas and then come back down to make sure that everything you painted here has a rich delivery of paint. Then you can go higher again because you've done the work here. You painted up, come back down, filled in any little pockets, and then went back up again. But it's reacting off of the imbalance that's seen here. Hits it, rejection block, projection mean threshold, sends it higher. Breaks lower, small little fair value gap there, candles low, candles high, that little piece of action going down. How does that get rebalanced? It has to be traded up to and through it. No, not through it, but to it. Here on the upper end of the fair value gap. And then look at the bodies of the candles. Yes, you have a lot of these little wicks in here. That's all broker based. But look at the bodies. They're respecting this gap. This right here is sensitive. This has always been in your charts and you've never noticed it. Now you're starting to see it. You're seeing how often it forms. Then you have another displacement, goes lower, creates another fair value gap right there. It's not annotated, but it's the same thing here, right there. This candle's low, this candle's high. Look at the bodies, filling in just to that point right there, and then there's a drop. That's a trade, that's a scalp right there to get just below this low. Selling short in here to run to this low here. At or just below it, and it hits it, boom. And there's the imbalance that's on your hourly chart again. It fills that in. There's all kinds of trades in this very chart that I'm showing you right here. On a 1 minute chart, you could be all over the place in this thing. But you have to have all this logic on your chart at the time working with it. I see it. I'm not dressing my chart up as I'm trading it. I can just see it. I'm looking at it without the lines on it. You, while you're developing, you want to have as much lipstick on your chart to see this thing over and over and over again that forms, and your pattern that you fall in love with, that your eye goes right to, that makes the most sense. And what does that mean when I say that? When I say stuff like, when you find your model, your niche, what does that mean? Well, this could be a model where you see a run up in price like this. It hits a level that would otherwise offer reasons to sell off. And then when you see price create a low, a break below it, and then there's an imbalance that comes back up in. Remember when I was talking about the dollar index, and I said if we gap lower, trade down into the fair value gap that was at the time in discussion, and if it trades back up to the bottom end of that fair value gap, I would treat that as a sell. Remember me saying that? This is exactly what that pattern was that I was describing. This is exactly it. And then it sells off. So if you know you have an imbalance that closes in with this line right there, and you want to sell off here, what is your framework? You're selling here and you're trying to get down here. So you can sell short here and buy it back about 5 to 10 pips before you get to that low. Period. End of story. That's your trade. Is it 1,000 pips? No. Is it 10? Yeah. Is it 15? Maybe. But if this same pattern forms on an hourly chart or 4-hour chart, this range could be 30 to 50 pips. You see how you can scale this? And you're thinking probably, oh, this only works on these lower time frames. No, it works on all time frames. All of this stuff works on all time frames. I just can't run it on a daily chart and a 4-hour chart and keep you engaged. It won't feel like there's enough setups to justify why you're paying me. This is the reason why I use lower time frames, because it does not matter if you are a swing trader or a position trader, or if you are a one shot, one kill type of trader. You can find every time frame, you can find your setup in it. It's 100% scalable. You can frame it to whatever size trade you want to make, because these things occur on all time frames, because it's algorithmic. Okay, the common expression I say, and many other people that use price action, they say that price is fractal. And when you hear that, if you've never heard it before, you're like, what does that even mean? What I've been explaining to you for the last 4 to 5 minutes, all of this movement here and how I've outlined everything and shown you all the lipstick on this chart. If this 15 said a W, there's no difference except for the amount of time it takes for it to unfold, because it would be a weekly chart versus a 15-minute time frame, where this can form multiple times in a week. Whereas if one of these candles represented a full week, imagine the amount of time it takes for all these things to unfold. It's just, there's no way I can run a mentorship just doing that. And plus, I don't have the patience. Like, I have to be doing things. And lower time frames give you a plethora of opportunities to practice, to study, and then forget these time frames. Like, don't worry about that time number. Just throw it out the window, okay? There's things that I'm going to teach you that are relevant to intraday, that only work in intraday, like the standard deviations and things like that, like central bank dealers range. That's salient to intraday charts. You're not using that on a monthly chart. You're not using it on a quarterly chart. You're not looking at it an annual chart. You're looking at an intraday chart, 15-minute and 5-minute, okay? If you look at everything else I'm teaching, the fact that it's universal on all time frames should be very exciting to you. Even if you don't fully understand what you're looking at here, trust me when I tell you, and this is, again, the charter members and the folks that have been here for a while, they're all smiling right now because they are remembering what it was like for them to hear me say these things and scratching their head like, man, he's feeding me a line of crap. All he's trying to do is sell me to the next payment. Trust me, okay? All of these things are applicable in all time frames. When you see me doing it over and over and over again, that's the reason why I give you the higher time frame. That's why I give you the daily. That's why I give you the hourly, and I give you the 15-minute time frame. And now I'm even giving you the 5-minute chart. I'm showing you how they exist on all time frames. And by doing it this way, it's teaching you pattern recognition, it's teaching you market structure, it's teaching you institutional trading, and it's giving you pseudo experience. It's filling in gaps that you don't realize you have that are filling in exponentially. And over time, you're going to start seeing things like, yeah, that makes sense to me. And just like this is one model here. Like, think about what would be described in making this a pen to pad model for you. In other words, how would you outline everything you see here in your own words to frame this? That's the pursuit of going through the mentorship. You are looking for that. And then I'm going to help you outline that in all kinds of different patterns and all kinds of environments with real market environments. Not, it's all static, in the past. It's not always electing to go to something that just is only in hindsight. But in the beginning, you have to see some of this at the very beginning. So that way, it'll mean more to you when I start pointing to when we're in liquid months. This is what I think is going to happen next. And when it unfolds, it just feels good. And you'll feel confident that you're in the right place. You're learning from somebody that knows what they're doing. But I'm also telling you when the market's not likely to do too well. And we're seeing it. Yeah, the market's moving around, but it's not really doing a whole lot. And even in periods where it's not doing a lot, you can still find setups like this. And that's why I say every week, every day, and it won't stop, because I can find setups like this, and you're going to learn how to do that too. But I would prefer to find something like this on a 4-hour chart or a 1-hour chart and get my 50 to 75 pips on something like that. And that's it. I'm done. And if this was everything else around that one single move for the week, I don't care. I'm running a mentorship, I'm running other businesses, and I'm trying to have, a family. So I don't need to be doing a whole lot. But right now you're learning and you want to try to trade this and this and this and I've been there before, but you don't need to do that. Right now, look for that one thing you want to do very well with. And then once you find that, then yeah, you can explore and do other things if you want, but you won't need to do that. You'll have your own niche, your own unique price action model, the thing that you go into the charts looking for that will repeat every single week. All right, 5-minute chart. Finally, this is our 28th of January 2021. If you're not ready for the annotations, pause your video. All right, on an open kill zone creates the low of the day. How incredible is that? We have a run higher, traded lower. I talked a little bit about this on Thursday, by the way, so I'm not going to give you everything here. We're going to talk a little bit about this price action there, but the price run here creates an imbalance. Then we have that buy side imbalance, sell side inefficiency, and fair value gap on the 15-minute time frame, which becomes this little fair value gap on the 5-minute chart. So it gets even further refined here. And then we have price running up, creating the high in London close, but then ultimately trading higher post 2 o'clock in New York time. But we also showed how that was actually right to a Fibonacci extension that turned out to be pretty accurate. I want you to take a look at this area in here and consider what might exist in the dollar index at that area. If you look at the dollar index, this orange line here, I've overlaid the dollar index. Now you can do this on TradingView by hitting the compare tab and then typing in DXY, making sure you're selecting the one that says TVC. And when you do that, it'll plot the dollar index right over top, but it's going to do it in a line chart. Now look what's happening here. You have the high and then a higher high in the dollar because it's a mirror image of what you see in euro. Well, watch what happens here in euro. We have the low and then we have the lower low, right? No, we don't see a lower low than this here. After this low, it's higher, higher, and higher. Well, the high here in the overlay on the dollar index line chart is high and higher. This should have been seen with a low and a lower low in euro. This is an SMT divergence. This is a crack in correlation. That's also indicating that this is relative strength in euro. And this was just a stop hunt on sell stops above this short-term high. That's all that is. This is a run on liquidity. And then it went lower on dollar. This low and the inability to go lower on euro, this is your SMT divergence showing you that the smart money is in fact buying in New York, and then you have the price run. So you want to include these things in your chart when it's salient. You also want to include in your charts when it's not there. So at every key turning point, you want to study and compare what the dollar index was doing. For instance, we have the low, lower low, lower low on the pound dollar. We have the high and then the lower high here. Well, it should have went higher than this one here because it went lower here. That would be a perfect symmetrical market. If you're new, you don't understand what I'm saying, trust me, it's taught. But for now, just know that you want to be comparing and contrasting the highs and the lows relative to the pair that you're trading against the dollar. So the dollar, in a perfect world, if it makes higher highs, euro should be making lower lows, cable should be making lower lows. But if there's a time when the euro makes a lower low or pound dollar makes a lower low and the dollar index fails to make a higher high, that's indicative of underlying weakness in the dollar. And that means there's probably going to be a turning point that takes place in euro or cable that sends it higher, and vice versa. If there's a time when the euro dollar is going higher and has a higher high, but the dollar index fails to make a lower low, the same thing is being said there, that you have underlying weakness in euro, even though it makes a higher high, and underlying strength in dollar because it fails to make a lower low when euro made the higher high. Now, I said a whole lot there, but if you listen to me carefully and you write down what I'm saying, those conditions are very important for understanding market correlation. If there's a break in that correlation or symmetry in marketplace, it is highlighting the fingerprint of smart money. They cannot hide it. They will never be able to hide it from you. But when you understand what you're looking for, it is like an x-ray view in the price action that sets up these nice big runs. Now, I'm not saying this is a huge run, but this is a nice run for an intraday chart. So you always want to look at your SMT divergence relative to the kill zones and the logic of what you're looking for. And finally, we've made it to the 29th of January for British pound versus US dollar. If you're not ready for the annotations, pause your video. All right, so we have again London open kill zone. Expect a low of the day to form in London. Runs up. New York open. We have a low, high, low. Institutional order flow entry drill. Rallies up into premium level. The high of the day forms just short of London close kill zone. Market trades lower, back into small little fair value gap that's not annotated here, and then consolidates back into the fair value gap again that's not being shown here, but is seen on the 15-minute time frame. And this goes ugly, but fills in entirely the buy side imbalance that's shown on a 15-minute chart. So I'd like to see it open higher, trade lower, and then make a run to go up into those objectives I've outlined when we were discussing the hourly and daily chart on British pound. That's what I'd like to see. But one of the things I mentioned in the last recording, and you'll hear me also if you go through all the previous commentaries and all the other lessons, the thing that I don't like about my own trading, and I'm saying this honestly, not to be critical of myself or teach you to be critical of yourself, but I'm being honest and I'm showing you my humanity here again, that I'm not happy with my exits because I'm trying to define the perfect exit strategy where I have a perfect entry. Well, I have a collection of perfect entry techniques. I'm not fearful of entering. It's one of my strongest points. My weaknesses are my exits. And you can see how the high of this particular day formed earlier than London close. I have studied, I've tried to work out why it does it ahead of the London close. And sometimes I think I've hit pay dirt, okay, or struck oil or found diamonds. And then I'd go forward with the ideas that I think I've unearthed and it doesn't hold up. So you're going to have to grow content with sometimes it not getting right to the London close kill zone and creating the high of the day when you're bullish. And that's why you have to take these PD arrays and take out your profits logically. That's why I'm not 100%. That's why I'm not always out at the exact highs or at the exact lows. I have trained myself to be willing to be out at a logical level and just know that I'm human and I'm not going to get every piece of the pie. So by seeing me do this with you also, it'll also condition you to just accept imperfection. If you are slightly off of imperfection, how can you complain? You're almost there, right? So contrast that with retail. They're hardly ever getting it right. And the books, they look good on paper. They look great in theory. But why is it that no one's making money with it consistently? Yes, I know you know somebody who knows money. They do this, they do that, they make money. Okay, big deal. Okay, everybody has a track record for a short period of time where they're lucky. And I got lucky for 9 months back in the 90s, and that was not skill. So if I would have looked at these types of things here, it would have conditioned me more realistically to anticipate not being perfect, but not also requiring perfection to do very, very well. I promised you that I would show you the Fibonacci settings on my trading view, and that's what I'm showing you here. So if you copy everything in your Fibonacci retracement tool, everything you see here, obviously the colors, you can do whatever you want with colors. I don't really care about the colors, but you can add more. Like you can, down here you can put in -4.0 or -4, and then -4.5, and then you can do -5, and then -5.5, and then -6, and then -6.5, and it would just give you more targets, for these bigger runs. And we are not seeing right now because the markets are really quiet. And I think that's going to be it. I gave you a whole lot here, folks, and I'm going to try to streamline this, and I'm going to be doing daily 5-minute uploads. Okay, so in other words, the charts I'm showing you here, that takes a little bit more time. I'm not going to be including them in the midweek and weekend edition because it's adding more time to the video than I really want it to be. So we're just going to do very, very short, like 5 minutes or less daily uploads. So it'll be a way for you to look over your shoulder, test yourself for the daily ranges. I'll try to have them up around 2:30 to 3 o'clock if it's all possible. Certainly be before 4 o'clock my local time, and it'll be very short, less than 5 minutes. Test yourself, this is what it is, and then I show you the annotations like this, and you'll see daily conditioning and daily repetitive pattern recognition training that trains your eye to see these things over and over and over again. And I promise, if you do a month to 2 months of doing this, you're going to start seeing it repeating. But just looking at it a few times and thinking, man, this is too advanced for me. Because I got a couple of people saying, I watched some of these videos and they seem really advanced. Do you have like a beginner's course? This is the beginner's course. Okay, it gets more difficult in the future, but it won't be something you won't be able to do. In other words, you'll be able to get through it, but you're gonna have to put some work into it. And I'm here to hold your hand. I'm gonna get you through it, but you have to do these things, and it's uncomfortable. It's like working out. Nobody really wants to do it, but everybody wants that really nice beach body. You gotta work at it. And I'm doing all the legwork for you. All you have to do is study what I'm showing you and try to mimic what you think you see in the charts before you see mine. That's all you're doing. And over time, you'll see how it gets better for you to see it. You're not going to see everything. It's not going to be exactly like my chart. If it starts becoming like that, then you're really developing, and that's good. But just understand, most of you won't be like that. So if you aren't doing it, you're not abnormal. It's not that you are slower than everybody else, and it doesn't mean that I'm not teaching you right or correctly. It just means that you need more time, and that's fine. You have the entire year that we're going to endure doing this. Just submit to it, okay? If you do it, you will start seeing it before it happens, okay? So enjoy your weekend. I'll touch base with you Monday after 2 o'clock or whatever. I'll sit down and do the video, and I'll update it, and I'll let you know on the community tab that it's been posted. Until then, be safe.